trading, this is not the case at all. You actually need to completely flip this on its head. The third thing is the misconception that making money on a trade makes it a good trade. This is not the case whatsoever. So let's look at this example so that you can understand why thinking losing is bad, being wrong is bad, and why making money, no matter how, is good. Okay, so think of it this way. Anytime we're buying into the market, one of two things is going to happen. It's either going to move up and we're going to make money, or it's going to move down and we're going to lose money. How we actually go about that as traders is what is going to dictate whether we're successful long-term or not. So let's look at it this way. Anytime we're entering the market, we need to, number one, figure out how much we're trying to risk, whether it's a percentage or whether it's a dollar amount. Say we want to risk $100, for example. That means that if we enter right here, we need to make sure that if price moves down to this level, that we're only risking $100. And in doing that, we can ensure that if this moves up 3x more, now we know exactly how much we're expected to win and how much we're expected to lose. So let's take that same exact example. We have our 1 unit of risk, which we know is $100 for 3x positive units of risk if we're right. So let's say, for example, whatever we're buying is valued at $153.52, and we want to risk exactly $100 on this trade. That would mean that we'd pull up our calculator. I'm going to show you a really cool, simple way to do this afterwards, but I want you to understand the math of how we're actually going to be calculating risk, right? If we want to position an entry in the market, we're going to take our entry value at 152, okay, and say our stop loss level, or this level where we're going to get out for a contained loss, is at 150.52. So we're going to subtract by the stop loss value, and that's going to give us 3. Now we're going to take the dollar amount that we want to risk and divide by 3, and that's going to give us 33.33 units to effectively buy in at, to ensure that if this moves against us, we're containing the risk to $100, and we know exactly what to expect if the trade moves in our direction. So anytime we're looking to enter into a trade, we're already positioning ourselves to accept the fact that we can be wrong and we can lose. And in order to actually get into the market and open ourselves up for the potential of making money, we have to accept that we could potentially be wrong. In that sort of same mind process, a lot of people think they need to be right all the time to actually make money in trading, which is 100% not true. So let's take this for an example. Say we take a total of 10 trades. We've contained our risk so that every time we're losing a trade, we're losing -1 unit of risk. So we have 1, 2, 3, 4, 5, 6, 7 losses and 3 wins. But when we're making these wins,